UOB posts record high earnings of $1.4 billion for third quarter 2022, up 34% year on year. Wow. UOB was actually my top pick in the previous video. So fantastic results, correct? How about OCBC? Up 31% year on year. Record profits also. Wow. So all in all, how did our biggest bank, who is actually today's focus, DBS Bank, how did it actually do? Let me show it to you now. DBS, record profits, up 32% year on year. Wow also. That's why I did say that for 2022, STI would outperform Nasdaq because STI, half of the weightage is already in banks and they have of course done tremendous results. Today's discussion is on DBS, correct? And if you look in terms of the 1 year performance, DBS is actually the best performer for that category. So fantastic results. And if you look in terms of DBS's share price, it looks close to all-time high. So the $1 million question, is DBS Bank still a buy right now? I'd like to address that for you. And if you're curious, continue watching on. Hi guys, welcome back. Without further ado, let's dive on to some important presentation points that I actually found. I'll leave links below to DBS's transcript for third quarter 2022. So this is the highlights. Over here, third quarter actually showed net profits increment of 23% quarter on quarter to $2.24 billion. The key part is returns of earning, ROE is 16.3%, both at an all-time high. So when it comes to analyzing the banks, there are a few things that we need to look at, and I've underlined in red for you. The first is of course NPL ratio, non-performing loans, which means you know a bank, they actually lend money to a company or a person, and if there's a default, this is called non-performing loan. So if there are no defaults, naturally there are no bad debts, which means that whatever monies they have lent out, they can actually receive back principal and interest. So non-performing loans, no problems with that, it's actually declined. Then how about the middle one over there? Non-trade corporate and housing loans have actually grown faster than first 2 quarters. My opinion is housing loans may peak sooner or later because I'm not that optimistic of housing, but data has shown that it's still growing, so that's good. But the key part on analyzing a bank's business is NIM, net interest margin. This has actually grown up by 32 basis points, 0.32% to 1.9%. Wow, so this is actually a key driver of earnings. And let me pull up an analyst report to really shape our discussion for today. What's mentioned by RHB is actually that they believe that there will be mid-single digit loan growth for 2023. DBS has actually mentioned risk of US recession spilling over to Asia, and that's why it's possible that the loan growth will actually tail off in 2023. Then what about for NIM, net interest margin again? It could reach 2.25% by mid-2023. Now this could also be a projection where Fed will finally stop the increments in terms of interest rates. So take note of that, later I'll cover back on this particular point. So when it comes to net interest margin, how it actually works is that banks actually borrow monies from us, correct, as depositors and from bonds they issue and stuff. And then they lend out the money. So that's the net margin that they make. And when interest rates are low, what they can charge customers is low, but they also pay us lower. But there's just a compression when interest rate environment is generally low. And that has happened for many, many years. That's why banks have not really done a 10-bagger if you look in terms of share price wise. But let's compare from last year all the way to this year. From 2020 all the way to 2021 and all the way to this year. You'd see that the net interest margin has actually dropped right in 2021 to an even lower rate of 1.45, 1.43% thereabouts. But then on the right hand side, you see that now it has jumped up very aggressively to 1.9% net interest margin. And as we know, the bulk of DBS's profits comes from loans. So if net interest margin is growing, you can expect that profits are indeed growing. And with that, I've actually found a very interesting point that I'd like to share with you. And before I get there, help me smash on like button and press on subscribe. Especially if you like content like this and you appreciate the work that I've done, putting in all the hours researching into this topic for you. Now this is what I actually discovered. When I read through reports, I realized that banks, they take deposits from us, correct? And that affects the CASA ratio, current account savings account ratio. What can we see in the beige portion of the graph? It's actually dwindled, correct? From June 2022, they actually had $382 billion. But then you see that in 3 months, they've actually lost 10% of that. Wow. Which means you and I, we're all moving monies out to T-bills, Singapore savings bonds, investments, etc., paying off loans. I think that's one key part also. So the current account savings account ratio has actually dropped significantly. That is why also DBS is raising their interest rates on the multiplier account in this news article, a similar move to OCBC's. Because if other banks and digital bank like Trust Bank is coming on board, snatching away customers' deposit, they run out of cheap capital. So DBS is actually raising their offer for multiplier, and in my opinion, this trend will continue. The competition will heat up all the way to 2023 because they want to preserve your deposits. So how else does DBS actually make money? This is another point to note also. When times were bad in the last few years, DBS relied a lot on fee income. For example, in wealth management, which is again the beige bar, you realize that has shrunk, correct? Because investment climate is tough. People are not investing that much. People are buying fixed deposits. And while other segments like transaction services and cards have made certain profits, all in all, the non-loan related fees have actually dropped. But no issues because the bulk is in loans, correct? If that grows, definitely DBS's profits will continue to grow. This leads to the next segment. Should you consider buying DBS or any of our bank shares? And before I get that, leave in the comments early on what is your gut feeling on things. I've actually broken down this segment into 3 key parts. Let's discuss firstly on the value of DBS's share. Now, as we can see in this chart over here, DBS against Mapletree Pan Asia Commercial Trust and Alphabet. I put these two in because firstly, I'm a big fan of REITs, correct? Right now, I think they've tumbled and probably too excessively. I do believe REITs are of good value. That's why I've done so many tutorials on it. You may agree or you may disagree, or you may be a tech fan yourself. That's why I put Alphabet's share price over here. Alphabet has of course lost 41.95% just in the last 1 year. Is tech better value because DBS has gone up instead, correct? It is arguable, but my gut feeling is maybe not yet. Maybe some point in future, 2023, absolutely. Because if you see in terms of ROE, return on equity, Google has actually seen a decline, correct, quarter on quarter, because Google is in advertising. When there's a recession, people cut back on advertising. Whereas DBS's climate is very different. The ROE is at all-time high, it's growing. So the business fundamentals for next few quarters are on different trends. In case you are curious where does this graph come from, it actually comes from today's sponsor, who's Webull. I'm a user of the Webull platform, and if you are looking for a good brokerage to buy US stocks like Alphabet, check this out. Right now, Webull has, for new users, up to $150 worth of cash vouchers. And if you really want to get invested, use my referral links below. And with that, I'll say a big thank you and let's go back to our tutorial. Point number 2, DBS seems to be well suited to a high interest environment. Now, the reason that bank share price is strong is because they are doing well, correct? That's obvious. Market is rewarding what they are seeing in terms of operational performance. So if you see in terms of share price, all-time high, you think it can't go higher, there are other angles to see things. If you see in terms of price to book value, you realize that DBS is indeed at a 1 standard deviation above its usual. But this is well deserved because in terms of ROE, it is at an all-time high. So it's making more monies than ever, which means it being in the more expensive zone is just natural. The bigger question is how long can this positive tailwind continue? That is the deeper underlying question that you need to ask yourself. In terms of net interest margins, analysts are also forecasting a big jump. That's why I drew these 2 arrows for you to see. Previous forecast was $12+ billion, but forecast now is $14+ billion. And for 2024, they've also marked up forecasts. That is why the net profit for DBS is expected to grow to a higher than ever level. So if interest rates continue to stay high or go higher than what everybody can expect, DBS's business is already well suited. You don't need to worry about high interest environment. So with that, let's move on to point number 3 to consider, which is DBS's dividend. Now, if you are retiree and looking for dividend income, you want a stable company that you're familiar with also. DBS pays right now 4.1% in terms of dividend yield. Now, for the last quarter, DBS also pays on a quarterly basis, which is helpful for passive income, and they are paying 36 cents per share. But you may be thinking, 4.1%, might as well I buy Singapore savings bonds and T-bills, correct? Why buy a share? Now, this is a common question that I see in the comment sections. But what many are forgetting is that when we look in terms of investment into a share, we forget that dividends are just part of profits. Because as I mentioned, ROE is growing, earnings per share is also growing. On a quarter-to-quarter basis, DBS has performed 23% above its previous quarter, which means that if they had the ability to pay 36 cents last quarter, they could easily have paid 40 plus cents, but they didn't. They actually kept that buffer, and that buffer actually still belongs to you as an investor. It doesn't dissipate. And speaking to here, I do believe that moving forward in 2023, it's very likely that DBS will pay an even higher dividend than in 2022. So if you're looking for dividend income, definitely this is a big point to take note of. So if that, I'd like to round up again. Should you buy DBS a share? You look in terms of value. How does it fare against REITs, against technology? Second, DBS is a well-suited company to high interest environment. Do you like that? Do you forecast high interest to be long-term or not? If it is, quite possibly this is a business to own. Thirdly, DBS pays dividend. If you're looking for passive income from a very stable source, DBS's dividend, in my opinion, is as good as it gets. So hopefully these are points for you to consider. And as always, if you'd like to learn more about investing into banks especially, check out my previous tutorial on UOB. I think UOB is even more focused on ASEAN as compared to DBS, which derives a lot of income from Singapore. So if you'd like to check out UOB, follow this tutorial over here, and hopefully it can benefit you better in your journey. Smash a like, smash a subscribe as always, and I'll see you there too. Take care, goodbye.